I'm going to show you the most important graph you will ever see when it comes to your retirement. This is not just why we diversify. This is the importance of withdrawing income and having an efficient withdrawal strategy in relation to your overall portfolio so you can meet your retirement goals. In just a second, I'm going to share my screen to show you exactly the risks that come in retirement and how you can avoid them. If there was only one thing that I could show clients, I would want to show them a financial plan. But if there were two things that I could show them, the second thing is going to be what I'm going to show you right now when I flip my screen. I do want to tell you before I show you this that I love helping people create a custom strategy. If you don't know already, my name is Taublieb. I'm a financial planner. I help people retire early. Otherwise said, I help people know when they are in a position where work is now optional to get the most life out of their money. Now let me show you exactly the real risks in retirement and how you can avoid them when it comes to your overall withdrawal strategy. Very exciting stuff, everyone. I'm about to show you right now. This is what we're on right here. I'm going to make myself smaller so you don't have to look at me on a big scale. I'm going to go in the bottom corner here. This is what we call Portfolio Visualizer. It's a great website that allows you to play around with all these different models. Now, I nerd out over this stuff, of course, but want to just show you the basics of what this can create for your portfolio, how you need to think about diversifying, because I know diversifying, you hear it all the time, diversification, diversification. Let's really see how this plays out in terms of your portfolio. So watch this right now. I'm going to take this off. I was playing around with it a little before to prepare for you guys, but what you can do is you can choose the start year and the end year, and you can go through this and change all of these cool variables, but let's keep it super high level. Let's assume you have $1 million and you want to know what would happen if you withdrew money. Well, if you withdraw money, obviously it's going to play an impact on the portfolio. It changes how you're invested, but let's just not even touch that. I want to show you the impact. So we have $1 million and I'm saying we're going to invest it in US large caps. We could invest it in anything, but we can start to compare. So let's start here. What if you had $1 million and let's say 1999 to 2021, we could pick any time frame here. I just said, hey, what if we're looking at right now? What happens is you can see that if we put $1 million in 1998 and we check now, well, great. All of a sudden we've got, call it by the time, 4.7 million today, which is great. You can go through all these different little summary here, which they do a wonderful job of. Started with $1 million, you've got 4.7. Here's your average growth rate, standard deviation, the best year, drawdown, all these cool ratios, right? So here's what you're seeing. Remember this, 1.1 million turned to 4.7 million, but you're going, Ari, that's helpful, but I'm going to withdraw off this money. So I've got $1 million. What does this really mean if I'm just invested this way? So now let's do exactly what I hope you're all thinking, which is we're going to say we're going to now take $50,000 every year from the portfolio. So let's analyze that once again. So $1 million, we're now withdrawing from it. Well, now all of a sudden you're going, Ari, what are you showing me? Well, this is showing $1 million. You're taking $50,000 every single year. And all of a sudden, we're running out of money in 2021. So you're going, Ari, how on earth is this possible? Well, the reason for this is when we look at returns, the way that you win in retirement is you don't pull when the market's also down from really poor accounts, because this is how these happen. So if you're just invested in large cap companies, you can see it's not just that we're down 9%. It's not just that we're down 12%. This 12% number, this 22% number, in addition to that, we're still withdrawing in that year. So the real risk here is we only have one place to pull income from. It's large cap companies. We get that. So you can see the real risk here as we look at this is that you're projected to run out of money and you had $1 million. You were in US large companies and it's scary. But I want to invite you to look at it a little differently. So what if we're in just a growth allocation? I can show you moderate. I can show you a million different things. But now let's take off this just for a second to show you. I'm going to analyze it with the 50,000 to show you what's the difference here. If you diversify, and this is exactly why we do it, to highlight it is, by the way, once again here, $1 million, you're taking 50,000 out every single year. And you can see here that your 1 million is projected to actually be positive, and with $1.3 million, and you withdraw 50,000 every year. Why is that? The reason for that, okay, there's even more down years if we add it all up. The difference is when these years are down, when you're down 5%, when you're down 10%, when you're down 28%, you don't have to worry because you have different assets that have gone up that you can pull from. And so the withdrawal strategy, I just want to highlight here, you can see your growth rate here over time. This is your inflation adjusted growth rate of negative 1.3%. Your best year, your worst year. You can see all these different variables. What if we put them together? And what if we analyze them? And you can see we can compare them and we analyze this to show you the following. And obviously, I get excited about this stuff because when people talk about running out of money, here's the risk. The risk here is you're just investing in one asset class and you go this way or you go this way. In this red, you're still going through ups and downs. I'm not saying you're not. You can see the difference, though, is you don't have different places to pull from, which really hurts you in retirement. So you can see here, which is fascinating, that as we look at this $1 million in portfolio one, you can see that overall, that when we look at this, here's the worst year, here's the max drawdown, here's how much it deviates. And overall, I say overall a lot because it overall connects to the strategy, which is it's not about hitting this amazing growth rate. It's not about hitting this amazing return. The way you win in retirement is by having different assets to pull from. And this red here I'm going through, this is that growth portfolio. Now you might be looking at this going, all right, I don't want a growth portfolio. Okay, great. Let's look at this. So we add in a separate portfolio. What if it's more of a moderate portfolio? And you can pull it in here. You can see it's US stock market, some bonds, global bonds, all these different portfolios. We analyze it again and we go through here and you go, okay, so now you're still projected to end with $785,000. You're this orange line here. The difference is you're not ending with $1.6 million, but maybe when you were going through this time period, you're going, you know what, Ari, it's a whole lot more comfortable. And those ups and downs, they just don't hurt as bad. It just allows me to sleep better at night. There's less, of course, gains from that. But at the end of the day, you want a secure retirement. And so this is just a way of illustrating. Let me zoom out here. Sorry about that. Is when we go about portfolios, I'll make myself a little larger to summarize, is overall, the way you win is not by having one asset class. It's not by saying, can I guess that's going to be the best asset class? An example I often share from January 2000 to January 2010, you would have lost money if you put $100,000 into the S&P 500 and checked 10 years later. You would have lost money. You would have had $91,000. That's not a fun return for being a quote long-term investor, even if it's just 10 years. On the other hand, if you're looking at this going, okay, I've heard you talk about that, but S&P 500, it's done really well for me from 2010 to right now. You're absolutely right. You would outperform what we're showing right here. But I know I'm nitty-picking years here because I have to pick something, but the point of what I'm showing you is it's not about saying, can I get the best S&P 500 returns? It's really not about getting the best returns. It's about diversifying so you can pull income from a different asset that's performing well when something else isn't. So once again, let's connect all of this to the portfolio. And this is all without even looking at tax strategy. So I've got plenty of videos on that as well. But when we connect all of this together, overall, your portfolio should reflect what's most important to you. And to most people, that's a successful life in retirement. That's excessive spending. We can go through what I'm showing you right now and go, what if it's $70,000 a month? What if it's $100,000 a year, and show you what is the impact of retirement. And this is exactly why we diversify. We don't diversify because it's boring. We diversify because it's effective in lasting your money. The last thing I want is for you to have $1 million or $2 million or $3 million all in a part of the market that could perform really well, but you run the risk that it doesn't perform so well. And now all of a sudden, the latter years of retirement aren't so fun. So want to highlight that when it comes to investing. If you want a custom strategy, once again, this is what I help people do. I love doing it. If you say, you know what, Ari, this is just helpful information, I kindly ask that you subscribe and notify yourself so you can see those future videos that come out, always making more content that I hope is helpful. But once again, my lead role is helping clients make sure that they have a secure retirement and one that really allows them to optimize their money. So once again, thank you for watching this video. And if there's someone you think would benefit from it, I kindly ask that you share it with them. Thank you. Thank you so much for watching today's video. If you don't know, I am the host of the Early Retirement Podcast, and this is what I love doing. I help people create a custom strategy to retire early. You can always reach out to me or a member of our team here at Root, and we would be happy to walk you through our planning process to show you how we can help you get more life out of your money.